Hey, what is going on, everybody? Welcome back. We have a lot to cover here today in the real estate market, and we also want to discuss the macroeconomic backdrop and what is taking place in the economy and how some of these factors like strong job growth and low unemployment are starting to impact the housing market, what it's doing to affordability and mortgage rates. We're also going to take a look at how home buyers and home sellers, including new construction, are adapting in this current environment. So you're not going to want to miss that. But before we get into it, huge thank you to all of those who are liking, subscribing, and commenting. It really helps grow and promote the channel, and I greatly appreciate it. All right, let's go ahead and jump right into it here. First, let's talk about the non-farm payroll. So we got a really strong jobs report that came out last week. It absolutely smashed expectations. They were anticipating non-farm payrolls to come in at 185,000. Turns out they increased by 353,000, and that's according to the BLS, the Bureau of Labor Statistics. Additionally, the closely watched employment report from the Labor Department on Friday also showed that unemployment remained at 3.7% last month, which means that unemployment has actually remained under 4% for a consecutive 2-year period. This is actually the longest stretch on record in more than 50 years. Average hourly earnings increased 0.6% last month alone. This is the biggest gain since March of 2022. You can see here indicated in this green line on the chart that we're actually up 4.5% year on year when it comes to wages. So this is a good thing. Notice here on this chart, we're starting to see wages increase, and at the same time, we're seeing CPI, PCE, and PPI start to decrease. And this is the trend that we ultimately want to see. We want to see wages outpacing inflation, so that consumers have the ability to purchase in real terms more goods and services. Now, this line here in blue, this is the core CPI, which is the consumer price index. This is basically the measure of the average change in time for prices paid by consumers for goods and services. You can see that we're going down. We're sitting at 3.9% year on year. I want you to know that even though the inflation, or the rate of inflation rather, is going down, this still means that prices of goods and services are going up. They're just going up at a slower pace. And of course, the Fed's target here is noted in this dotted line here at the bottom. You can barely see it, but they have a 2% target rate of inflation. We're still pretty far above that target, nearly twice as much. Now, we did see core PCE. This is the personal consumption expenditures. This is the primary measure of consumer spending on goods and services. You can see that has gone down right here, down to 2.9% year on year. Now, when I see this, I don't know if this is necessarily a good indicator for the overall growth of the economy. Basically, what this is saying here, if I'm understanding it correctly, is that personal consumption is going down, meaning consumers are spending less on goods and services. Could be an indication that the consumer is getting squeezed here in this market. And right here in purple, you can see that we actually ticked up a little bit. This is core PPI, producer price index. We're sitting at 2.5% growth year over year. This is basically the measure of inflation at the wholesale level. In other words, it measures the average change over time in the prices of domestic producers receive for their output. And generally what happens is if the cost for producers increases, that starts to roll down to the consumer in the form of higher prices for goods and services. Based on the report and all of this data, the economy overall is showing strength. And as a result, the market is starting to price in fewer and fewer rate cuts going into the future. And that, of course, is referring to the federal funds rate, which they held steady at the last meeting in January. And you can see the next meeting coming up in March has the probability that the Fed will keep rates the same, 525 to 550 basis points. There's an 81.5% probability that Fed is going to hold the rate steady. Now you can see that the market is still pricing in the probability that rates will drop going into the end of the year, but it is at a significantly lower probability than it was even a month or two ago. By the end of the year here, coming in December, the market is pricing in with a 30 35.7% probability that the Fed funds rate will be about 125 basis points lower than where it actually is today, which of course would still be a dramatic move. But the fact that the Fed has yet to capitulate and they have not moved rates down, they're holding rates higher for longer, really sent a message in the bond market. And you can see here what the 10-year Treasury yield has done on that news. We saw a massive spike up. We were sitting under 4% with the 10-year Treasury yield, but very quickly, I'm talking within a day, we jumped up over 4%. At the time of this recording, we're at 4.15%, which of course rolled over and impacted mortgage rates. We saw a big spike in mortgage rates here as well over the last 7 days or so. In fact, they edged up back over 7% for a brief period of time, now sitting just under, with the average 30-year fixed mortgage rate sitting at about 6.97% for a conventional loan. The government products are going to be hovering in the low 6% range. And the fact that home prices have remained very resilient, they have stayed elevated, and mortgage rates have jumped substantially, affordability is still a major strain on the economy for potential home buyers and potential home sellers. And not only new home builders are having to adapt to this, but existing home sellers and home buyers are having to adapt to the new norm as well. Here's an article, or a chart rather, out of Resi Club with data provided by Parcel Labs that actually says new single-family homes continue to get smaller while maintaining similar pricing structures in order to maintain margins. In addition to that, on last month's earnings call, D.R. Horton, the CFO, Bill Wheat, he told analysts that in order to adjust to the changing markets in 2023 and 2024, they've had to increase their use of incentives along with home price reductions and the sizes of their home offerings where necessary to provide better affordability for home buyers. What home builders are having to do to adapt in this new market and move inventory, they're not only having to offer things like closing cost credits, rate buydowns, maybe design credits in order to upgrade the home, but they're also still taking price reductions along with building a smaller product. In this chart here, you can see that existing homes here highlighted in orange, they've stayed relatively stable with regards to the average square footage. 10 years ago, we were at 1,593 square feet for the average home. Now we're sitting at about 1607, so it's marginally higher. But if you take a look at new construction, look at the median square footage. 10 years ago, we were sitting at about 2,300 square feet, and now we're hovering just over 2,000 square feet. What's important to understand is this is really not a new trend. In fact, over the last decade, new construction, the median square footage has actually dropped. Last year's reduction, which was the largest, by the way, at about a 3% reduction in square footage, marks the 9th straight year that new single-family homes have gotten smaller. Now, these homes have gotten smaller while at the same time, the median price per square foot has increased pretty steadily at about 4 to 5% over the last 10 years, with the outlier years being 2021 at 13.7% and 2022 at 18%. And you can see that back in 2023, we saw a marginal increase compared to the prior years, but an increase nonetheless. And what this article from Resi Club is essentially comparing this phenomenon to is something we would call shrinkflation, where you're reducing the size, quantity, or the weight of a product instead of actually increasing its price. So for example, if you take this can of Pepsi, let's say it costs $1, you get 320 milliliters. Well, instead of increasing the price and maintaining the same size, what they're doing is reducing the size to 250 milliliters, maintaining the price at $1. It's important to emphasize that Resi Club isn't implying anything negative by the use of shrinkflation. In fact, from an economic perspective, it makes a lot of sense that the rapid deterioration in housing affordability, with mortgage rates quickly rising from 3% to over 6% in 2022 alone, it would lead builders to opt for strategies that could, at the margin, keep affordability in check and maintain sales. Now, the strain on affordability is not contained only in new construction. It's spilled over to existing home sales as well. According to Redfin, pending home sales actually posted their biggest decline in 4 months. That's dampened by the rising mortgage rates. Now, it has been a bit of a bumpy start to the 2024 housing market. The mortgage rates, they did post their largest increase in over a year on February 2nd. And as I mentioned earlier, that jump came after hotter than expected January jobs report and the Fed's confirmation that they're unlikely to cut rates in the next 2 months. Redfin goes on to note that rising home prices are exacerbating the rising rates, with the typical monthly mortgage payment just about $100 shy of the October's all-time high. Now, here's a couple key metrics that I believe are important to pay attention to. According to Redfin, median sales prices coming in at $361,498. This is up 5.4% on the year. That's the biggest increase since October of 2022. It's important to note that while some markets did really well, they saw more year-over-year price appreciation, others did not do so well, but on a national level, home prices are still going up. Median monthly mortgage payment is sitting at about $26.07 per month. That's with mortgage rates at 6.63. That's not accounting for the rise in mortgage rates that we saw recently. So odds are next week when this report comes out, when we get the data for this week, we're probably going to see that number tick up a little bit. Year on year, that average monthly payment is up 11.5%, again, putting a strain on affordability. But the average monthly payment is down about $110 from the all-time high, which is a record set in October of 2023. Pending home sales, they are down 7.8%. We have new listings increasing 6.6%, while active listings or inventory on the market is actually down 3.5%. With all of the data and information that we're looking at here today, we're still in a what I would consider a challenging housing market. It's one that is fairly complex to navigate our way through. I can tell you anecdotally from what I'm seeing in the Northern California market, we are starting to see a lot of homebuyer activity come off the sidelines, get back involved. Home tours are up. We're starting to see multiple offers, and some of these properties even going above the ask price. Now, of course, that's going to be different in each and every single market. If you are a potential home buyer or home seller, you want to make sure that you start working with a professional who really understands what's taking place in your local market. And with that, it's going to wrap up the video here today. Hope you got some value out of it. If you did, consider liking and subscribing. We'll see you on the next video. Thank you so much. Take care.